Hi there, welcome to Finance JCL. I've got 3 stocks to buy for you. These are a combination of US and UK stocks. Just before we start, a quick disclaimer, I'm not a financial advisor, and therefore you should make your own investigations and decisions and not just copy exactly what I'm doing here. Relating it back to the conditions for success if perhaps you're a new investor, today we're going to be looking at the screening. So I've done some screening for you. And I picked 3 stocks I think could be buys. I'll have a look at the qualifications part of that and also the valuation point as well. So let's get started. First one is Direct Line Insurance Group, which is a UK-based insurer. Just to confirm, I own a position in this stock and have done for several years. So I'm thinking of this as a kind of Peter Lynch stalwart type stock, whereas the growth is probably fairly limited, but there is a potential large dividend, and it's a strong company with a good brand here in the UK. So we have a look at the revenue here. The last few years it's been very, very steady. And the net income has fluctuated a little bit, but it's been broadly flat. Now the earnings per share, again, relatively flat, but it is a bit better than it was 10 years ago. But the payout ratio's got a bit lower recently. And the number of shares, again, is relatively flat. So this one, all about the dividend. It's an insurance company, so I'd normally look at book value per share as well, but it's trading at a price of about £3, which is above the book value. So it's not undervalued, but it could be a good buy if you've got quite a lot of cash and you're looking for a way to monetize or make that cash work for you a bit better. We'll have a look at Yahoo. You can see here, if we look at the last year, yeah, it's fluctuated quite a lot within a range, and it's just around £3. We look at the statistics. First of all, the trading PE is under 12, so it is a pretty low PE ratio, although insurance companies don't tend to trade on high PE ratios. The forward dividend yield is 7.42%. That's highly impressive, and that suggests that it's a good place to put your cash, assuming that dividend yield obviously continues in the future, because it's not guaranteed. I'm looking at their investors page. Looks like as well they have in the last few days been buying back some of their own shares. And we'll have a look at Simply Wall Street as well. They are saying it's about 50% undervalued. Now, I'm not 100% sure I agree with that valuation. I think that's based on quite a low discount rate. But what I do like is the low P ratio. They're looking at around about potentially 7% forecast annual earnings growth, which would be very nice. See here the earnings per share should go up in the long run. And you can see here the debt levels are very low in comparison to the equities. That is very pleasing. So to summarise, I think this one is a good dividend option. I think the ex-dividend has been missed for the current payment, so you might want to take that into consideration. So the second stock to buy is quite well covered on the internet. The second stock to buy is Tattooed Chef, American food company, ticker symbol TTCF. This is quite an unusual growth company. It definitely does fit in that Peter Lynch growth stock category. That they're growing quite quickly, but they are making profit as they grow. So you can see here, revenue $85 billion, then 248, and they make net income from 5 to 67. So it's a very impressive level of earnings. And in fact, the earnings per share is $1.69. Given the price is $17.48, that to me looks like a price to earnings ratio of around about 11. The company has this high net margin that we've just seen, high return on equity. The current ratio looks very good, and the debt is almost non-existent now. And we have a look at their price chart. And I have topped up on this recently. You'll see it in my eToro copy traders account. And I've also added it to my 1 million challenge account. Looks like now it's quite a good price to get in at, and I have managed to lower my average price a little bit. Have a look at their site. See here, it looks like they've got quite a lot of cash. As of February 22nd, cash balance now approximately 200 million, which is very impressive. They are also launching art-based products, which is their kind of speciality. Target stores nationwide in America. So this is a very large potential opportunity where their product is getting stocked in a much wider range, wider number of stores. This suggests that especially someone like Target wouldn't be ordering this unless the products are selling well. I think there is a very good short and long-term future for the company. It's very interesting though, can they continue to grow, making these sorts of margins? I'm not so sure, but the fact they have been so far is very impressive. Let's have a quick look at Simply Wall Street. So they're even suggesting undervalued. I think 26 is a fair value. The current revenue of around about $150 million is projected to go to $450. That's tripling in the space of less than 3 years. Very impressive. And we should say some people might be alarmed by the recent insider selling. However, the individual insiders still own 43.6% of the company. So for me, I'm not too worried. They are massively invested and tied to the success of the organisation. Okay, so there we have it for that one. So we move on to the third company. Now, just before I do that, if you do want to buy any of these companies, there is a link down below for UK investors to my Freetrade referral link, and you will earn, if you're new to Freetrade, a free share of up to the value of £200. And for example, you could buy a direct line through that process. If you're an international viewer, there are two options. I've got Interactive Brokers linked down below as well, and they've got access to a very wide array of securities. I do own TTCF and the third stock we're about to discuss through this portal, Interactive Brokers, through this platform rather. And then finally, if you are interested in what I'm buying right now, I guess I've got two portfolios. One is the £1 Million Challenge, which I recently updated you on, and all three of these companies are in my £1 Million Challenge portfolio. I have just started an eToro, which I'm going to move towards the sort of copy trading popular investor space. If you want to have a look at that portfolio, which is completely new, I'll drop a link in below. So last but not least is Unum Group. Now, I've flagged this one previously actually in 3 stocks to buy, and I'm going to flag it again. And I like this as a stalwart company and potentially undervalued, because I'm looking at the revenue here. You can see it's ticking up, ticking up, ticking up. Not massively, but it is going up. Net income is a decent number. Dividend, look at that, increasing every single period. That dividend has increased. The payout ratio has always been low. It is still particularly low at the moment, just 25%. Further to that, the number of shares has been decreasing. They've knocked off about a third of their shares. So this company is very much creating shareholder value by growing the dividend and reducing the number of shares. And in fact, you can see that's increasing the book value per share. The book value per share is around about $53. The market price is around about $29. So there's a big margin of safety there if you're looking at price compared to book value per share. This is why I'm suggesting this could be a stock to buy. Now, have a look at this. The margins aren't massive, and perhaps as typical with insurance companies, they're never going to be absolutely huge, but they are pretty consistent. And their debt to equity, yeah, it's reasonably low. They don't have any debt problems, in my opinion. You see here the price graph in the long term. It's been up and down a bit, but it peaked in 2018 at around about the 58, 59 mark. And it's been trending down ever since. And you can see a particularly large drop when the virus came in. And imagine getting it then at 10, you're already at almost 30, and potentially you could get to 60. So anyone who bought at that point, my hat is tipped to you. That's very impressive buying. And have a look at the statistics for the company. Trailing PE 7, forward PE 5. That's very, very low. Price to book 0.54. Dividend percentage forward and trailing around about 4%. You don't want a portfolio full of fast growers, probably. Good to have a range of different companies. I do like insurance companies because they do get the money up front. So look at this. It's definitely a Peter Lynch stalwart. Good dividend, which is growing. Low payout ratio, which could grow. And share buybacks. So there you have it. Those are the 3 stocks I'm suggesting that you go and have a look at. And then finally, if you would like to join me on Patreon, we can discuss these stocks or any others in much more detail. You can have a look at my wish list. Additionally, if you want to support the channel, there is the option there. Very much appreciate it. Thank you very much. And I'd like to hear if you've got any stocks that you are buying at the moment. If you drop them in the comments below, it'd be really interesting to see whether anyone else has picked these ones up or they have some better ideas to share with the group. Thanks for watching, and I will see you on the next one.